Good morning, everyone. Welcome to the Huatai and SSI very timely discussion on the China stimulus, the flows, the fundamentals, and the potential impact on Vietnam. My name is Thomas Nguyen, and I am the Chief Global Markets Officer for SSI Securities. And I again welcome you. We are all calling in here. At least Fad and I are from Ho Chi Minh City, as you see on the screen. Ning, if you could wave. Ning is actually calling in from New York City, and Xiao Yu Chen, as you can see there, the handsome man in the white shirt, is actually calling in from the Hong Kong desk of Huatai. To say that I am excited about this call is quite an understatement. I can't imagine a more exciting time to be in this business, in the markets. I don't remember the last time I can recall the two biggest economies in the world, the two biggest markets in the world, transitioning to a much more accommodative mode. And it's a very exciting time to watch these two significant areas in the world transitioning, and of course, looking into how it benefits places and exciting places like the Southeast Asia region and especially Vietnam. I'm particularly excited about this panel, frankly, because of what you can see on the screen. This is a great collaboration between two great friends, two great partners, SSI and Huatai Securities. As many of you know, SSI, we are the dominant local securities firm in Vietnam. We have deep roots here. Our value is to be the gateway to Vietnam, and we will continue to press on that. But what's as exciting and really exciting for me is we have amazing global partners and global friends like Huatai. For those of you who may not know Huatai, you should. Huatai is a dominant player in China. On a revenue basis, it's one of the leading securities firm in China. It actually has the biggest international business of any of the Chinese securities firms. And for some of you, you may have heard that Huatai has secured the first ever trading account in Vietnam by a Chinese firm. I'm really proud to be sharing this discussion and collaborating with Huatai on this such a timely discussion and an important discussion. So with that, let me transition over to our esteemed speakers. I'm going to start with Ning Ding. There, Ning, if you could wave. Ning again is calling in from New York City. I've known Ning for quite a long time. She runs sales and trading for Huatai in the U.S., the biggest office, the biggest operation for any Chinese securities firm in the U.S. At the moment. In fact, if you're ever in New York City and you want to go to Park Avenue, you can meet Ning and the impressive team there. The one thing I do know about Ning, she is absolutely the best Chinese broker on Wall Street. That just means that some of her clients are some of the most prestigious and some of the most the smartest investors, not only in China, but in the emerging markets and in the region. So with that, it is my pleasure to welcome Ning to the stage for her views on the fundamentals of what's going on with the China stimulus.
Thank you so much, Tom, for the introduction. If I can acknowledge the best Chinese broker on the street, I would have to say, because I am a trainee of a great mentor, which is you. I got the great pleasure to work with Tom from 2015 until 2022. I would say it was the best 7 years of my life. So good morning, everyone. I'm truly honored to join this call today, and especially thrilled to be able to work alongside my former boss once again. So as Tom mentioned, today's webinar is about the flows and the fundamentals of China's stimulus. So my colleague Xiao Yu, one of the smartest people I've ever worked with, will cover the flows, and I will focus on the fundamentals, aiming to answer a straightforward question, which is what happened? So the answer in simple terms is a change in policy tone. As many of us understand, especially in Asia, how something is said sometimes is more important than what is said. So Chinese officials are demonstrating a determined attitude to support the economy, and they're doing so with an unusual sense of urgency. I'm actually borrowing the term unusual urgency from Huatai's wonderful chief economist, Eva Yi. I believe many of you may have joined her webinar on September the 7th. To briefly summarize Eva's insights in my own words, the unusualness comes from three things. First, the timing of the conferences. Second, the fact that the PBOC, or the Central Bank of China, pre-announced the policies for the first time. And third, the clear, let's just do it tone. So the urgency part can be seen through the policy red packets. That's what we normally say, which include very supportive monetary policies, innovative programs aimed at boosting the capital market, and a variety of measures to improve property affordability, reduce housing inventories, and ease the financial pressure on developers. And more importantly, as we know, financial markets often trade on expectations. There is anticipations around the details of the pre-announced fiscal easing, along with measures to support income, employment, and consumption. So the details will be released in the next 3 weeks, and I think market is really excited about it. So to save time, I won't dive into the weeds of the policies for now. Plus, I think no one really explains them better than our chief economist, Eva. So I highly recommend asking us for a replay of her call in English. In short, many believe that China is prepared to do whatever it takes to support the economy. That wraps up my presentation, and I will now hand it over back to Tom.
Thank you, Ning. Thank you for those comments. And I have to poke at you a little bit because, the world is full of skepticism, and maybe that's not quite the right word, but maybe anxiety about how real all this is. Certainly US-based investors, the big long onlys, the hedge funds have been moving out of China for quite a few years now. And so my sense is, although this feels like shock and awe, if I was sitting in their shoes, I would ask myself, what's different this time? How real is this? And should we react?
I think Xiao probably have better answers from the flow perspective, but I will pitch in first from sentiment perspective. I was actually on the call for 12 hours straight yesterday with US investors, right? People basically have the same question about, first of all, is this real? Right? Are the policies real? Are we going to be disappointed in 3 weeks? That's number one. And the second is the anxiety part that you mentioned, right? Everyone is underweighting China. That's just everybody knows, right? Everybody's underweighting China. So should they catch up? Should they catch to neutral, or should they overweight? So I think those are where the anxiety comes from. So I think to answer the first question, is this real? I probably will answer it through giving you a few data points of what's kind of different, right? So what are real right now, what we can see, is the PBOC cut RRR, which means 1 trillion RMB liquidity in the market. And they cut the existing mortgage rate by 50 bps, which means Chinese people are spending about 150 billion RMB a year on mortgage spending. That means you have more disposable income. And they also have two innovative programs right now in the market. One is 300 billion RMB facilitating for re-lending purchase. And the second is a 500 billion RMB programs to do swap. And those two, based on, and I quote PBOC's governor's word, is if 300 billion is not enough, there can be another one and another one. If the 500 billion is not enough, there can be another one and another one. So I think the real comes in the numbers, and they're happening right now. So I don't have a crystal ball to tell you, oh, how real the physical policy is, but I think it's very clear that something is coming out. The government will follow their promises as to support. The most important one is income and support employment. We've seen a lot of documents coming out and policies and guidance on them. So that's why I don't want to dive into weeds, because then it's not a 45 minutes call. It will be a 45 minutes call. But I want to say that the policies are real. And in terms of the if they should chase the rally, one of the very important thing I learned from my clients, especially from the emerging markets, long only clients, right, who have the pain from trading on China for the past few years. So that's why they're underweight. But the interesting nuances here is, even though they underweight, they didn't underperform much because of the core holdings they have. So yes, it is a P word, but it's not a pain, it's a pinch. So people are anxious to say, if I should catch the rally, if I should go. But I think in the end of the day, for long only clients, they care about fundamentals. They care about numbers. So they're fastening their seatbelt, trying to see that what number will come out on the physical side. And then as third quarter earnings is right around the corner, so people can actually do their models and do their expectations, price in a reasonable GDP growth next year. And then they will say, if we want to pull the trigger. But for the hedge fund clients who actually have been naked on China, it's a little more painful for them. That's why you've seen, right, very big hedge fund managers come out in the United States, say, all in, everything, I'm buying everything of China. It's easy for him to say that. He can move it in a week, but that's not, in my opinion, a very responsible way to look at how you really invest from a fundamental perspective. So I would say anxiety is real, but not as much on the long only side. The big heavy ships are slowly turning. But I'm sure Xiaoyu will have more points, because he really lives on the front line of where the flows are and how clients trade. But based on my conversations, those are my conclusion. First of all, it is real. And second of all, people are anxious about position for the upside.
Thank you, Ning. Thank you for all that. And before I hand it out over to Master Xiaoyu, I'll just reflect a couple of thoughts on that. I think, no one really truly knows how real it is, shall we say, until we look back at it. But maybe to echo what you're saying, the pain is real. And I'll tell you why. And for our audience who are in Vietnam, the move in the China market over the last, let's say, 12 days has been roughly $1 trillion in terms of market cap. Stop to think about that. In 10 days, the Chinese market have moved almost $1 trillion, which is roughly 5 times the size of the overall market in Vietnam. So whether these policies become real or not, the pain is real. The movements are real. And it's going to be very interesting to look forward ahead to see how it impacts the economy and works its way through the system. With that, let me just say a few things about Xiaoyu. Xiaoyu is one of the most intimidating men I've met in quite a while, because he's extremely smart. Studied in Tokyo, speaks brilliant Japanese, worked for Morgan Stanley there across different asset classes, came to Hong Kong to run equities trading for Morgan Stanley, and fortunately for Huatai, he has joined Huatai as the head of trading in Hong Kong. Not only does he run the flow trading desk, but he comes from the background of Delta One structured products. So his view on what clients are doing is very deep and very broad. And with that, Xiaoyu, I nervously hand it over to you to just talk about things that are way over my head, my man.
Thanks, Tom. Thanks for those beautiful compliments. really honored, thrilled to hear that. So first of all, I think I'm gonna echo back on the topic of if it is real or like how different it is this time, right? From my perspective, I would say the you can rarely see say when a series of policies going out, and the government officials and the senior guys, right? They're working so well coordinated and well structured. So you can see for those you can see the central banks, the PBOC and regulatory parties, they sit in the same room, they announce the major measures all together. You can rarely see that happening in the history of Chinese policy rolling out. Normally it's like one department rolling out their policy, and this time it's all so well structured and organized. So I would say, and it delivers a very strong tone to the market saying, we care about the capital market, we care about the equity capital market. So that's really a very strong tone, which is again really rare in a history. And also after the policies rolling out, you got the party bureau meeting stating about how they care about the economy, care about the market. Normally this is not the month that people discuss about economy during the party bureau meeting, but this time it's like in September they just happen to discuss that. That emphasizes the how much focus they have put on to the market these days. That's really a very positive sign. And also, they address the property market, which has been under the focus these days, because a lot of people do believe that if the Chinese property market, if it doesn't recover, the equity market will still keep suffering, right? So they address the key concerns. Okay, so you care about the property market. You know what? I'm going to give you some policies, right? And then right after that, they rolled out some policies about unemployment issue, which is also one of the concerns that has been like really annoying investors. It's like oh, the China youth unemployment rate is too high, and this and that, and they address that right away. So you can see from the frequency of the policies rolling out and the way they organize it, it really delivered a very, very strong determination to the market saying, I do care this time, right? And also the 300 billion plus 500 billion that Ning just mentioned just now, said this is the first batch, but it's not enough. I can roll a second batch, I can roll a third batch. Basically, that means that it's very strong confidence, right? Put in the market saying, I would do it as long until it's sufficient. That's the message. So thinking about that, it's this time it is different, right? It's definitely something different that I would say. And also, Tom, I know you're a very long time in the Wall Street history, right? There's one thing that I learned. I joined the industry in 2009. That's one thing that I learned is don't fight the central banks. Don't fight the Fed, don't fight the central banks. That's just like, if you're in this industry, you went through the crisis, you went through all those things, you know it. You don't fight the central government. And a similar thing for China. China has a stronger government, right? It's very, powerful. So if they have all the measures well designed and it's well planned, and they're so determined, okay? It's not like just one department, it's like everybody on the same line, on the same page, we're gonna boost the market. And once that tone is out, so determined, what my get is, just don't fight the government, don't fight the central banks. I think that's the wise thing to do. So, I mean, that's the first take on, how real it is, how I feel how it goes, right? And now let's dive into like who is buying, right? Which I think it's a lot of people's focus area. They want to know, like, who's participating, who has been active in this market, which is a very interesting topic, but it's also it's a question that no one has the exact answer unless you have a gut view and exactly who owns how much asset and who is doing what. Okay, so from my perspective, let me break it down to like different types of investors, right? So that, you know, has a better understanding of how it's going on. So first thing is the retail investors. Retail investors in China mainland, it's similar to Vietnam or Korea. A retail plays a very important role in the market share, in the turnover, right? So in China, it takes roughly, I think it's over 50% to 60%. Is the retail participants, right? So if they wake up, if they really want to, you know, participate in this market, they can be really aggressive, or it can create quite some impact to the market. And as you saw,
could you remind us just roughly percentage-wise, like in Vietnam, we usually say that the retail makeup of 90% of the marketplace and the volume, the activity, and so on. In China, is it much different than that?
Yeah, as I just said, it's roughly, again, it's some statistics back on like 1 year or 2 years ago. It's around 50 to 60%, roughly around that range. If more people coming in, you know, it could be more, right? So especially there's a, you know, I think you read the news about the curbs on high frequency funds, which meaning, you know, the institution, if they, you know, shrink a little bit, then the retailers may take a bigger cut on the total market share. So, just you know, just another thing of the China mainstream for Hong Kong, the retail clients is less than 30% of turnover. Hong Kong is highly institutionalized, so it's a slightly different. But regardless, it's Hong Kong or China mainland, you can read on the headlines of, you know, Bloomberg News or whatever news channel you have. It says what people are queuing up to open up a securities account, right? It's like, you know, even for the long holidays now in China, still, you know, people are trying to like how they can open up a securities account. A lot of brokerage firms, they're readjusting their, you know, holiday plans, you know, just to cater for these kind of like massive demand on the business. So that's the retail part. And an interesting story for my colleagues here in Hong Kong, it's like he hasn't heard from a friend for a long time. It's like, you know, old friend, haven't spoken for years. And then all of a sudden, the friend shot over a message saying, "Hey, buddy, do you think I should get into the market now?" You know, that shows the very typical thing about, you know, people are really getting, like they really woke up, right? They're really getting interest, aroused by this market movement. It's like, ooh, something's going on. So that's the thing that's really driving the market sentiment for the retails these days. And aside from the retail guys, you got hedge fund clients, you got long-only clients, right? Roughly break down. For hedge funds, you got so many different types of hedge funds, right? I'm not gonna illustrate like every single type of them, but you got you know, you know, quants, long shorts, fundamental, you know, long buys. You got many sorts of like event driven, right? But for those that went on the headlines, right? Those hedge funds, you can call them fast money. They can really get in and out really quickly. They can turn around. They can change their view like overnight, right? So that's what Ning said. That shows their passion or enthusiasm at the moment. But as for how long it lasts, it's a question mark. And for those who reacts the quickest, maybe the macro guys, right? They can really get in just by the index futures, they can buy the ETFs en masse, right? That's the way they can get the quickest approach to the market. Whereas if you got the long short guys, or especially those like platform hedge funds where they have a very strict risk controls, which does not allow them to have a big delta in the market, right? You have to be long short neutral, or you can have a exposure, but up to what percentage, right? Also, you got a very tightened maximum drawdown control on those funds. For those clients, it's not that easy for them to just all in, because the time they put longs, they have to think about the shorts. They need to think about how to hedge it, especially for these type of like violent market can go up really sharply, and it can pull back, right? It can have some consolidation, like what happened yesterday in Hong Kong. So it's they need to think about all these factors. So for them, it's not necessarily very easy to just all in right now, right? That's the type of clients who, again, could be the main driver of the latest, you know, especially for Hong Kong, where the majority is like institutional money. who drove up the market. It could be them. As for long onlys, you got two types. I roughly break it down to passive funds, passive long onlys, and I got active long onlys, right? The pension funds or those, like you could call them endowment fund, they can be the active money. They don't just buy ETF, they don't just buy the components, right? They have their own discretions on which company they think is better, right? Which is not. They should overweight certain companies rather than the others. Those funds are now, as what Ning mentioned, they are cautious. They're not super convinced on is it real or is it how linked to the fundamentals. That's true. But for those passive funds, for example, we're benchmarking MSCI China, MSCI emerging markets, right? You have to put some weights on China. Otherwise, you will comparatively you're going to lose compared to the benchmark, right? And when your performance goes bad, then you know what, you got a serious issue. So for those passive funds, willingly or unwillingly, you just have to put some wagers in the market, and which also showed in the EPFR data, which shows the subscription and redemption of those passive funds, which shows like a big inflow to Hong Kong lately, right? So in short, who could be the buyers in the market? My assumption would be the retail guys, that's one thing, and also the hedge funds who react really fast, and those passive funds, the passive inflows. As for long onlys, the active guys, honestly, we really don't know when they're gonna shift their mindset, turn around. Especially the US long onlys, they're the hardest guys to convince, right? But the thing is, again, let's think about this way. You got how do we determine a price of a stock or price of all the companies? The simplest model is it's the EPS, right? Earnings and times the PE ratio. Look, so previously, China has been so undervalued, or due to whatever concerns they may have, it's very like depressed value. So the PE ratio should be at a historical low, right? Now, even after the rally, we're still comparatively cheaper than the US, not to mention India and those really crazy markets. So I mean, just to put the PE ratio recovery, you call it confidence trade or what, doesn't matter. It's the PE ratio recovery itself could even double, right? The current index level. So I mean, it's just with the PE ratios recovering, it could have a chain of effects. Let's put it this way. You think about, well, the topic may go a little bit, further away, but I think it's okay for you. If, let's say, the people have been talking about deflation, right? Have been talking about deflation in China. Why would this deflation happen? One thing is you don't have a very bright future, like hope for the future income, right? They think, oh, I may earn less the next year, right? If you keep thinking about that, and unemployment rate is not helping, so people may get concerned on their expense, right? But if you have something, previously was the property, right? The property holds the main Chinese assets, so they're not concerned if they hold a house, right? And they hold something real estate, and they know worst case, I just sell the real estate, boom, I'm done, right? I can still live a happy life. But with the real estate market not working well and the employment rate is not perfect, so you can see there's pressure, and especially on people's mindset, they tend to be more careful when they spend money. But with this series of measures, I think the wealth, the wealth storage pool is shifting from the property more to the equity market, right? If it goes into the equity market and market is booming, and people think the stock they hold today may increase their value a lot in the future, what would happen? They would think they have more money, right? They would think they're richer, wealthier in the future. And what would be the consequence? They would spend more money, right? And if they spend more money, it will stimulate all sorts of things, and deflation may just walk out. So I mean, it's a chain effect. With the deflation going away, and companies have brighter, prettier numbers going out, you know what? the earnings improve. So you got the earnings improve, the PE ratio recovery, boom, your price will keep going up. That's a healthy cycle. Let's keep like rolling up, right? That's the thing that I think everyone wants to see. So
you, if you don't mind me asking you, so what you're saying is you guys believe that this time it's different, or that
yeah.
Is that, you know, certainly that's from a policy perspective, but are you seeing the trading volume, the behavior of clients reflecting that this time is different? In some sense, what I really want to ask you, Xiaoyu, because you've been a trader for a while, when was the last time you saw this type of pivot, not from a policy perspective, but from a behavioral perspective?
Right.
And the follow-up question to that is, what's, you know, versus a month ago, you know, what has changed since these red packet policy moves have come out from your desk? What you're actually seeing in terms of behavior?
Right. That's a very good question. So I'll give you a set of numbers, right? The after the measures being carried out, and you can see that especially on September the 30th, it's literally the record high for Hong Kong market, like historically record high. Give you a sense, like, you know, in Hong Kong, roughly, if you trade like 100 billion Hong Kong dollar a day, that's like, you know, you got a good day, right? Over that. So that's roughly how you put it. It's around 13 billion US a day, right? And on September the 30th, that day alone, it's like 65 billion US. So that's 5 times of the average, like a good day average, right? So that means how crazy, or, you know, how buoyant the market is. So people are really like excited. They just want to get in first, right? Regardless how it goes, how long it lasts, but you have to be in the market, right? To join the market. And for China A shares, it's similar. Before the measures, it was around 80 billion US on average. And on September the 30th, again, it reached around 370 billion, right? It's almost 5 times the average. So that from that angle, you can see, like, you know, it's real money buying, right? And it's not like, you know, very small volume, small turnover. That price action may not last, but for this time, with this type of volume going on, it tells you something, right? It's not just fake flow. It's the real money participating in the market. But having said that, is it unanimously everyone think it's good or it's going to last? Definitely not, right? And the amount of buyers out there, you have the equivalent of sellers on the notional at the same time. So I think the market is still battling, especially at the very first stage of a turnaround market. Most people, they choose to be smart. I mean, smart not being rushing to the market, smart being cautious. They want to wait out to get more clarity. They want to see more certainty, right? But that's the trade-off. If you wait out to see more clarity and certainty, you lose a wave of, you know, rally, right? You may earn less. But again, smart people may say, you know what, I don't care about the first round. If it's a clear path, I'll put more money, right, in the second wave, the third wave. That's what they think about. That's also typically what the longlies are thinking of, right? So and also some hedge funds, they may think they may have different views, right? They may think, okay, you know what? Maybe it's good. It's a real like monetary thing, but as the fiscal policies are yet to be rolled out in specifics, and also the earnings may not review where the market think it should go, so they choose to short. There's also some clients doing that. So again, there's 2 ways of ideas or thoughts, which is the beautiful thing about the market. You've got different views. People trade around. If you got just one-sided, you know what, there will be like limit up all day long and there's no trading volume, which is not good for everyone. So, well, I mean, that's healthy. At least we can, have different views, and then the opposite views may just join the long side later on. You don't know, and the long side may flip their mind into selling, and which again is the beauty. Again, there's a lot of people asking, like, how long would this last, right? Is this going to sustain or things like that? And I mean, I'm not a research, I'm not going to tell fundamentally how well it could be, right? We need to wait until the numbers to come out and to prove things. But just by thinking about where the capital is and how either going to be incremental capital or less, right? Just from that angle, you can briefly think about it. People are still, again, the retail guys, they're still queuing to open up the securities account. And those who got hurt, right? They may not flip their mindset right away. They may just say, hey, can it be a fake ready again, right? Can it be, if I rush in right now, could I get hurt? For those who got injured previously, they may be a little bit more cautious, right? And when they flip their minds around, there's another way of a capital, right? And now the mutual funds in China, I don't think they got a lot of like new subscriptions or fund inflows as of yet. Once they have that, boom, there's another inflow, right? And also think about those swap plans. If they can, the mutual funds, they can swap their ETF assets into the government treasury and use that as collateral to raise more funds and buy into the market. Boom, there's another round of capital injection. So there's so many different like aspects of the capital they're not in yet. Not to mention the global money, the longlies, right? The big money, they're still waiting on the sidelines, right? Some may have put some chips in, but not everyone. And just as Ning said, a lot of people, they're still asking, who's buying? Who's buying? And who would ask that? It's someone who hasn't really participated yet, or who hasn't put the real money in, right? So again, thinking from all those angles, would the market fundamentally change? That's $1 million question. I don't know. I wish it could, but just from the capital flow wise, you can see that the upside, the probability of the upside is way bigger than the downside. That's what I can say.
Yeah,
Okay.
I want to add one thing. Sorry. Add one thing to Xiaoyu's point. He gives very details on the vertical elements of the China markets. And if we can take one step back and look at the global market, we have been talking about $1 trillion market move, right? We have been talking about 30% rally since middle September for Hong Kong market. We have been talking about MSCI China now in 10 days is the best performing market in the world. But wait a second, because if you look at every single other market in the world that are performing, they're at their historical highs. Your S&Ps, your India, your Japan, they're at historical highs. And whereas HSI is, Hang Seng is still about 22% below the 2021 peak and 25% below the historical peak. Right? We can argue all day long that if they should, but the fact is after a 30% rally, they're still 25% below. And for MSCI China, it's still trading at a 20% discount versus SCCI emerging market. So if you're an investor with money and you look around globally where you have a promise and a very, very, actually a accommodative valuation level, I think the question is actually quite easy. So, and also last thing I want to add is Xiaoyu's point about the retail money. So some people may argue that, oh, when the retail money is in the market, it's like the height of the bull, right? Because that's what happened in China 2015. But what's very different this time is that it was bone dry retail liquidity before this rally, means that no retail investors have been really in the market. It was very different than 2015. And if people were joking with me, they say, oh, it's the grandmas and grandpas that they're opening stock market, accounts or trading. And let's just put one number in mind. Mom and pops in China saved up 146 trillion RMB in the bank, which is 20 trillion US dollars cash. So let's just put things in perspective, right? And we can think about it. A lot of things are different. That's why this time is different, because history does repeat itself, but never exactly the same narrative. So that's what I want to add.
I'm speechless. You must have had a good teacher. So thank you for those comments, Ming. Xiaoyu, thank you for your comments. There's a lot to chew on, but given the context, Paul, and limited time, let's shift to Fat, as I call it. Let's bring it home, Fat. Fat here
Yes.
I'd say he is my right and my left-hand man here at SSI. Fat has had an amazing history. Most market participants in Vietnam should know about Fat at this point. Has had an amazing career, mainly buy side, mainly on the investment side. Started with us many years ago, went to Dragon Capital, worked at Pure Heart, and now we're lucky enough to have him back joining the sales and trading team here. I always say Fat is a much better version of me. He's younger, he's better looking, and he's a lot smarter. So Fat, go ahead.
Thank you, Anton, for your introduction. Yes. Currently, I'm very optimistic about the China government stimulus package, as well as the outlook that the China economy can recover. Of course, someone can say, have a question that whether it's real or not. However, if we give the expectation that the China economy recovery, it will affect the Vietnam a lot, because you know that China is the second largest economy in the world, the second largest stock market in the world. And also our neighbor, we have a long history and relationship with China. So we also have the same border with China. So given possible recovery of the China in the coming time, as well as currently escalation of the stock market in China, I believe that some sector, of course, I will talk about fundamental. Some can impact the Vietnam. So I believe, I expect that given the possible recovery of the Chinese economy, commodity price in the world will recover. So, for example, the steel price, the oil price, the rubber price. So, the steel maker in Vietnam, after the news that China implement the stimulus package, is enjoyed a lot. Of course, this can be from sentiment, and we have to wait for further information, any change in the earning growth. But at least we see the trend that will coming higher in the coming time. The second thing is, as Sao you already mentioned, I really love your idea about that the consumption in China will likely improve in the coming time, given the higher wealth, the more assets, their assets price increase in the future. So given the consumption improving, we expect that the Chinese tourists will likely come back to Vietnam higher and higher in the coming time. We should remember that before pandemic years 2019, the number of Chinese tourists accounted up to 30 to 40% of the total tourists coming to Vietnam. But until now, we only got around 70 to 75% of the pre-pandemic level. So given this, we expect that Chinese tourists will come back to Vietnam higher and higher in the coming time. Given the aviation sector as well as some travel company can benefit from this. And the next thing I want to emphasize that now agricultural products and the fruit export from Vietnam, the major market is China. China accounted for the fruit export of Vietnam roughly around 60 to 70%, huge number. And the second thing is about the textile and yarn export. Remember that Vietnam export the total amount of yarn. China accounted for more than 50% of yarn export from the Vietnam. So given this, a lot of sector in Vietnam can benefit given the strong and recovery of the Chinese economy. So that's for the fundamental. The second thing I want to emphasize that given the strong and the close relationship between the China and the Vietnam, as well as our government, maybe in the coming time, I also expect that the Vietnamese government also do something like this. I will not say that the magnitude, the scale will be as much like this, but we expect there's more liquidity in Vietnam. That's also the reason why in recent trading session, you see that the banking sector recover a lot. I want to emphasize again that in Vietnam, banking sector accounted for 40%, more than 40% of the total VN index, and given their importance. So banking sector might benefit in the coming time. Of course, there's some debate Some house in Vietnam, some research house in Vietnam argue that maybe it's quite difficult for the central bank in Vietnam to cut the interest rate further. But given the liquidity, the monetary easing, the new monetary easing cycle, as well as the liquidity around the global market, I believe that there's still room for the central bank in Vietnam to lower the interest rate further by the end of this year as well as next year. So that's for the fundamental about the impact of the China on Vietnam. How about the flow? We all know that during the first 9 months of this year, Vietnam experienced increased selling pressure from foreign investors. Foreign investors, they are net seller with the record high, nearly $3 billion. This is the highest amount since the establishment of the stock market. However, just look at the performance of VN index. We still managed to have a return of 14%. 14% is maybe the best among the regional peer, for example, compared to Thailand, Indonesia, Philippines. So given this, the answer for this is the support by the retail investor. As Sao you already mentioned, in China's retail investor accounted for around 50-60%, but in Vietnam, retail investor accounted for 90%. And given lower and decreased interest rate, they can come back to the stock market higher in the coming time. So given possible flow from foreign investor, increased flow from the retail investor, I expect the valuation of the stock market as well as the VN will increase further in the coming time. Back to the recent flow, after the Fed decreased to cut interest rate, we see foreign investor begin to come back to Vietnam in recent trading session, and they become net buyers. At first, they buy the banks. It's quite easy because if you want to have exposure to the Vietnam stock market, you can buy bank. But now in recent trading session, we observe and see that they buy other stock from other sector, for example, consumer stock. So given this, I think that demand for the Vietnam stock market from foreign investor come back. And we think that this trend can sustain further in the coming time, given the new monetary easing cycle. Thank you, and Tom. That's my comment about the impact as well as my view.
Thank you, Phat. If I could counterbalance it a little bit, and this is a soft, maybe a really dumb question for both you and Xiao Yu, is there's always a cautious side to me, maybe because I'm so old and I've gone through so many different cycles. But Vietnam has really enjoyed being arguably the prettiest girl at the dance, or the most handsome man at the dance, in the region for a while. And then overnight, you have the not only the biggest, but the biggest is now up 40% in a blink of an eye. And so there's an anxiety about me that all the attention that we have gotten, deservedly so, maybe shifted towards back to what I would call as the cornerstone of the region, which is China. We can't argue that, is that right? China is the cornerstone of Asian markets. And so my anxiety is maybe short term, if the markets in China continue to unleash this animal spirit and this excitement that flows into Vietnam might soften at least. So as I'm saying this, I want to slap myself because I know it's a short-term thing, but I'd love your reaction, Xiao Yu, as well as Phat around this.
Yeah, sure. I mean, that's a very interesting question as well. So I guess you're gonna have to break it down into the short-term effect and long-term effect, and what is just the flow-driven and what is the fundamentally driven, right? So for the short term, the people's reaction, again, it's we're humans, right? And the capital it's smart and it chases for efficiency. So for a foreigner, when they deploy their capital, they're looking for the best way to express their view, the best way they can make money. So they will flow, most likely, the attention will shift to China more because they were too undervalued previously. So they will have put more focus or attention on China, meaning there could be, say the pool of cash remains the same. They may have a bigger cut on China in the near term. but think about things in an evolving way. So once China, again, it reaches to a certain level where the expectations and the reality, the balances on a certain price level, it goes there. And then what the capital do, they will seek for the next wave of growth. But where is it coming from? It may coming from the surroundings and all the countries that has closer ties to China, right? Who could benefit? As Fab just mentioned, like tourism or exporting exporters to China. So those are the areas that could benefit. Maybe not the first round, but can come in the second round. But the capital, again, they seek their efficiency. Once it reaches the balance in China, it would definitely shift this attention away, right? And from another, like I put it in like an example, right? Just like when you choose your neighborhood, again, do you prefer to choose someone who's sick and weak, right? Or do you prefer to choose someone who's healthy and strong? I guess the answer is quite obvious, right? You want to have some neighborhood who is strong, right? And not, well, I mean, not in the bad way, but strong and caring, right? And who can bring the neighborhood along. So China's that kind of like existence in the region. So if China goes strong, the economy gets better, it will have the spillover effect to the surrounding, like, countries, which benefits everyone in this region. So in that sense, I guess, again, short term, that could be some capital reallocation, but as Fa has already mentioned, the capital, the foreign money outflow has been ongoing for like a long time, right? And did it impact your market? No. Does it hurt if a little bit more to shift away? I guess not, right? So there's nothing too much to worry about, even in short term. So I guess it's maybe 99% a good story for Vietnam.
I'm sorry for the dumb question, Xiao Yu. I beg for your patience.
No, it's a
Going
smart
back,
one, smart one.
going back to the to the audience here, Fat, and I'm gonna force you a little bit. There is no doubt that China is Vietnam's biggest trading partner. So what happens in China will significantly happen in Vietnam. So what I'm pushing you, Fat, is leave the audience with the one or two sectors in Vietnam, assuming our thesis is correct, that this time is different and China is going to recover, and it's all real. Which are the two sectors that you think will experience the most upside from this theme? Just to leave our listeners with something defined and something for them to think about.
Yes, of course, and Tom. So for this, I will try to answer in from two ways. First is about the fundamental, and the second is about valuation. So from the fundamental, given my expectation, first I will expect the banking sector, because if the economy in Vietnam will really be stronger thanks to the internal demand as well as external factor, given there's a stronger Chinese economy, banking sector will really benefit from this because you can make the loan easier in the coming time, and also you can manage the asset quality. The second thing is I'm thinking about the exporting sector. For example, there's a lot of name in the exporting sector, like for example the agricultural companies, fishery. For example, we SSI also have a company bank also focus on agriculture products. So given this, I can say that two sectors I will love. First, the exporting sector, and the second is the banking sector. Besides, also for the exporting sector already benefit in the coming time, given the recovery of the whole global market. They have a growth is really high in the coming time, in the recent time. And for the banking sector, the valuation is low. And the outlook is brighter given that higher loan growth, control assets quality, as well as the possible improvement in the NIM, net interest margin, in the coming time. So given this, I can give you the two net. That's the two sector I will choose in the coming time.
Got it.
If I can add here on the agriculture, sitting in New York, I always shop on like those big Asian grocery online stores. And I'm telling you, as my PA is growing very well, I'm buying a lot of those $8 Vietnam pomelos. and coconuts and mangoes.
Yes.
So I'm telling you, it's not only the Chinese are buying your fruits, the Chinese sitting in the New York and the United States are buying your fruits as well. Just FYI.
Great. Okay, guys. Well, look, our time is running out, and I'll just make some closing comments and maybe summarize as best as I can. There's a lot here, but I think the message is clear. Is that based on what we've heard today from Ning and Xiaoyu, that this time seems to be different, and I love Eva Yi's terminology of unusual urgency. That's beautiful. Is that right? And the nuance of China policy, China decision making is important to listen to those words very closely. So our base case is that this time is different, and this is real. And that leads us ultimately to the conclusion that Fat's delivering, that, you know, obviously, given the fact that we are the biggest you are the biggest trading partner to Vietnam, that your health means our health. And, you know, Fat in many ways is telling us that all roads lead back into the banking sector in Vietnam. Because frankly, the banking sector, at least on the indices, account for 30 to 40% of our index anyway. So a healthy Vietnam economy, a healthy Vietnamese market means a healthy banking sector in Vietnam. So as much as we've spent an hour talking about a lot of nuance and stuff, I think the message is quite clear to me. And so, you know, to sign off, I would just conclude this. You know, as I've said to many investors, and I'll say it over and over again, I do believe that this is a once in a generational window for Vietnam, our economy, our country, our capital markets. But this time, I would say, it's as much driven by external factors as it is internal factors. And this is a perfect example of that. Our two most biggest trading partners, our two most important trading partners, the US and China, are actually going through very exciting transition. And we certainly will benefit from that. So in closing, it's an amazing time to be in this business. It's an amazing time to be working with Huatai Securities. And it's an absolutely amazing time to be at SSI Securities. With that, thank you for signing in, everyone. There will be a replay of this. And if you don't see it automatically, please contact your SSI representative. Thank you, Ning. Thank you, Xiaoyu. I love you, Fat. We'll talk to you soon, okay? Cheers.
Thank you,
Have a
guys.
good day and a great weekend, everyone.
Bye. Bye, guys.
Bye. Bye.